podcast where we put you on the map. This is Ron Costa broadcasting live from the Mappable USA Studios in Las Vegas, Nevada. And folks, we know the only constant in life is change, and that certainly applies to opportunity zone investing. And today we're going to go over some of those changes. Before we get into that, though, let's introduce Vicki Hutchmala from the QOZ Marketplace and the Opportunity Zones Authority.com. Vicki, how are you today?
I'm really fine today, Ron. It's a beautiful day in Vegas, as it always is. This is why we live here for those, 1 week of winter and the rest just beautiful. But today we have one of our smartest guests that we've had before on podcasts, and he's going to explain to us about opportunity zones, investing, capital gains, and cryptocurrency. So this should be exciting. I can't wait.
Yeah, there's a lot to cover today. So let's introduce Blake Christian. Blake is a tax partner over at HCVT. Blake, how are you today?
I'm doing great, Ron and Vicki. It's always great to be on the show.
Yes, thank you very much for being. Yeah, Blake, you've been on the show many, many times. You provided a lot of information for people, and today we're just going to go at it with all these changes that are happening. But before we do that, in case someone hasn't heard you on our show before, can you just give us a really quick background on yourself and maybe what HCVT does?
Sure. So I've been a practicing CPA for 4 decades, so it's gone by pretty fast, but 40 years in the business. And most of my career I've concentrated on some of the niche tax planning ideas, various tax incentives, hiring credits, equipment credits, green credits. And so when the Oz program came into being, I started getting a lot of questions from people saying, hey, tell me about these Oz credits. And I said, well, they're not credits, but it's even better and more powerful because it's a tax exemption. So I kind of got sucked into it 3 years ago just because of my prior practice. So HCVT is an LA-based firm with 12 offices, about 65 partners, and a total headcount of over 720. I work out of the Long Beach, California, and the Park City, Utah offices, where it's snowing quite a bit today, so a lot different weather than you're having there.
Well,
we're glad you have it and we don't.
At least you're not in Texas. Texas is getting hit hard with snow, believe it or not, these days, huh?
Yeah, I've seen that.
Wow. Well, anyway, I guess we should go into this whole thing with the new changes with this opportunity zone investment. Blake, you've been a panel on a lot of expos and trade shows and online conferences, so you really have a great understanding on what's going on in the market, opportunity zone investing wise. So let's go over a few things. What do you think is a significant change over the, let's say, even January 1st since the year has started?
Yeah, so right before President Trump left office, he left us a final opportunity zone gift, and the IRS extended the reinvestment periods and made it even more taxpayer friendly. So IRS Notice 2021-10 came out in January, and basically it allows investors that had gains that would have been reportable between April 1st and December 31st of 2020, an additional 3 months to make their investment. So March 31st is kind of the looming deadline for people that had gains in that would have had to be reinvested in 2020. And actually, the way the rules work, if you really analyze that notice, is even 2019 gains, many of those, especially if they came through on a K-1 or were after October 5th of 2019, those gains can still be deferred into an opportunity zone fund as late as March 31st of 2021. So it's pretty powerful. You can amend 2019 returns and so a lot of people are still in the in the window to make these very powerful investments.
Well, do you think that now, after what it's been about 3 years now since the program took off, are you seeing that more people, not only more people interested and knowledgeable about opportunity zones, but are the rules and the regulations and everything a little bit more set in stone so people can be comfortable about investing in opportunity zones?
Right. It's an excellent point, Vicki. And it took, we have about 900 pages of regulations, and those went through, 2 proposed phases, and then the final phase came out the final set came out in December of 2019. And so we've had pretty good clarity. From then there was also some correcting regulations and then some other announcements. So, I would say, 95% of the issues are pretty well settled, but, every week we're dealing with some areas of gray and, and trying to get clarification on that. But I have to say that, the IRS and Treasury, even though it took a long time, it's a complicated program, and they did an incredible job. And in almost every case, the rules are very taxpayer friendly. So, and most practitioners, I think, are pretty happy with the way the regulations came out. Not perfect, but pretty close to perfection.
And there's probably considerably more data history to look at and to see, to anticipate progress into the future, because there's more information now than there was that made people apprehensive about actually even doing anything with opportunity zones. Where do you think it's going to go in the future?
Well, the question that we have been getting the last few months with the change in administration is, well, is the Biden administration going to support this, or is he going to dismantle the program? And as I've mentioned on your show before, the Oz program, the genesis of the program and the architects of the program came from the Obama administration. So President Biden is aware of the program. He supports the program. He's publicly stated that throughout the campaign. And then Vice President Harris is also a fan of the program, and she recognizes the entrepreneurial aspects of it because, again, you can use this for both real estate as well as operating businesses. And, probably about a third of our projects within our firm are operating businesses, which are, really impactful, a lot of sustainability, and those are going to be the grand slam investment opportunities, even more so than the real estate.
I think you're right. Yeah. And I would, just to take it off onto a tangent here, Blake, with all the news and volatility going on in the Bitcoin and cryptocurrency world, I would suspect that gains from any kind of trading in that arena would be a perfect opportunity to invest in opportunity zones with all those capital gains. What do you think?
Absolutely, dead on, Vicki. And we saw that, there's two things going on in the investment market. Crypto, our clients really weren't, adopting that. A handful of them were, but I will tell you, it's become pretty mainstream. Our clients recognize it's highly volatile, but they do feel that, Bitcoin and the other cryptocurrencies are going to be here to stay. And so they are making investments, and they are having, 2020, early 2021, that market's been on fire. And so I've had several clients, they'll come in they got $1 million, and then by the time we set up the fund, they've got $3 million of gains. We roll those gains in there, they diversify, they plow it into other businesses that they have, and then they push that, that tax recognition out to 2026, and they position themselves for tax-free appreciation after 10 years. So it's, they really like it. Now, the problem is most of the hardcore crypto investors want to go right back in, and so I have to kind of pull in the reins and say, nah, you can't just sit there and plow, keep plowing crypto in there and hold it for 10 years. The rules aren't going to allow you to do that. You can do that to a certain degree. You can do it up to 5%, and you can do it for a short period of time during the working capital safe harbor, but a lot of care has to be exercised during those periods. And then the other thing that, it's not just the crypto, but, people are sitting at home, they got a little more time, they're on their computer or their secondary computer, and they're trading all day. And, you couldn't do that necessarily easily in the office, but when you're in the comfort of your home and nobody's watching, people are doing that, and they're making a lot of money doing that. And so again, the benefit of these short-term gains, they're highly incentivized to defer the gain, because otherwise they're going to be paying tax at typically about a 40.8% rate, 37% base rate on short-term gains plus 3.8 the Obamacare tax. So and then you layer in the state tax, and 50% of their gain goes poof. So they like the idea of the deferral. The other thing is you don't have the rate risk, and we've talked about this over the last few months with the new administration. Biden has talked about even long-term capital gains being taxed at rates as high as 43.4%. So you could be deferring 23.8% maximum long-term capital gains right now, and then in 2026 end up with a 43.4% tax rate. That would be really, a bad result. But on the short term, you're already at a 40.8, and so your worst case under what Biden's talking about is 43.4, and you get a 10% basis bump after holding the fund for 5 years. So that wipes out that extra tax. So anyway, again, short-term, to summarize, short-term capital gains, Bitcoin, day trading are perfect matches for the Opportunity Zone program.
Yeah, your story reminds me of that joke about the guy who's on the phone with his financial advisor, and he says, he goes, I need, where should I put my $1 million of Bitcoin? Because I need to find some place for my $2 million, because if I'm going to invest $3 million, and it keeps going higher and higher in the same conversation.
Yeah, it's really amazing. I'm watching it right now, and I think it's at 48,000. It went over 50,000 earlier this morning. So.
Wow, it's just great. And then you made me laugh a little bit, Blake, with your last story about being home in the home office. You should see my home office here. It looks like a cross between the Fox Studios and a sports book with all the screens up there.
I can imagine.
And a serial killer's plan, huh?
Uh-oh.
Well, okay, let's not go there. But getting back to what you were saying before, Blake, about the changes, one of the things that I find kind of confusing, maybe I shouldn't, but this whole 180-day investment period, that's been extended as well, or what's the story with that?
So, the only time that it's really only 180 days is if you're holding, let's say you're holding Amazon stock in your personal name or in your grantor trust. If you sold that today, the 180-day window starts tolling today, and so you have 179 days thereafter to make that investment into a qualified opportunity fund. That's the
right.
only time it's only 180 days. Now, if that gain's coming in on a K1, your 180 days won't start till March 15th of 2022, and so it takes you out to September of 2022. So it's very seldom only 180 days, but don't. Anybody that's going to make an investment, if you have a gain, talk to somebody and make sure you know the exact timeline. But usually you have much longer. And the example I was telling you with the 1231 gains earlier, which are trader business gains. So if you held rental property, if you held an asset in a business and that was sold at a gain, goodwill, any of those. They, again, if they're coming through on a K1, that clock doesn't start ticking until March 15th of the following year of that sale.
Okay, all right.
Opportunity zones. Oh, I'm sorry, Ron. Opportunity zones, the program is simple and direct, and use your capital gains, invest in distressed areas, make the world better. It's like so simplistic, but putting it together is kind of like rocket science, and you need somebody like you, Blake, who really understands the fine points of creating a viable opportunity zone fund that will go into the future and still work in 5 years or 10 years or something. You really need to have professionals like you who can help with that process. Even the program is pretty simple.
Yeah, you're absolutely right. Fundamentally it's a straightforward program, but you're right. You have to, we have to get financial projections or help clients with financial projections to say, hey, we could make this work right out of the blocks. We can make it work for 2. They give you a lot of freedom for up to 55 months to kind of, do what you want with the money. And you can be looking for permanent investments. But after that period of time, if you failed the test, then you're, starts really diluting the benefits, and you could actually blow up the fund and have a taxable event. So we spend a lot of time on the front end structuring these and making sure the client understands how they have to operate this, because it's a long-term commitment, 10 years to get all the benefits out of it.
Yeah, and that leads to another question too, from what you talked about before, Blake. One of the questions that a lot of people have that's very confusing is the 30-month substantial improvement period. What constitutes a substantial improvement, and that's been delayed as well? Is that true?
Right. Under the 2021 IRS notice, they basically froze the substantial improvement period from April 1st through March 31st. They just extended it through March 31st. So if you bought something 6 months ago or 2 years ago, that 12-month period is frozen and does not count against you for that 30 months. So somebody that bought something that they're improving prior to April 1st, get an extra 12 months, so that they've got 42 months to make their improvements, and so that's a real plus. What a lot of people get a little nervous about that, especially if you're doing a project, say in California, where the zoning and approvals take a long time. As long as in the regulations, as long as you've applied for zoning or variances, etc., and if the government's holding up your project, they'll extend that 30-month period. But as you mentioned, it's as long as 42 months for people that bought their project before April 1st of 2020.
Yeah, if your opportunity zone, I was going to say, if your opportunity zone fund that you created involves business creation versus, let's say, real estate, does the 30-month substantial improvement period still apply?
It can if you bought hard assets. If maybe you bought a business and it also had a building associated with it, then the building component of that, you have to double the basis over that 30-month period. But or you could have some machinery in there. Those you would have to increase those asset, the asset base on those also. But as far as the rest of the money, if it's just improving a business, they only look at the hard assets. So you could have a bunch of goodwill, intangibles. Those don't have to be substantially improved. They're not counted in the overall test.
Right. Okay.
Go, Ron.
I was going to say the next thing that really comes to mind that really makes a lot of these funds go toast is this whole idea about a 90% investment standard, right? For these funds. Any changes in that?
Yes, they basically suspended through December 31st of 2020. If you didn't meet the 90% test of having qualified opportunity zone business property held by the Qualified Opportunity Fund, the upper tier entity, they will not penalize you for that. There's just an assumption that that's COVID related, and it was an inadvertent miss. So that again, additional relief there, and so most people most investors are not going to have to set up their QOZB subsidiary until roughly June 30 of 2021. One of the other huge benefits under the 2021 IRS notice is if you form your qualified opportunity zone business, the subsidiary entity, by technically we're interpreting it as June 29th of 2021, and if you drop the cash down into that entity by that deadline, then you get a 55-month period to reinvest those proceeds. Now, you still have the substantial improvement test running parallel to that, so that you don't get 55 months on that. But if you're establishing a business, if you're just looking for an asset to purchase some real estate, you have up to 55% to deploy that cash. So that's an important clarification, Ron, is back to your substantial improvement. The substantial improvement clock only starts ticking when you buy a piece of real estate with a building on it. And so that 30-month period may not start for 3 years. You might take 36 months to find a property, and then that's when the clock starts ticking. So you've really got all of these timelines are pretty investor friendly, and we very seldom have encountered that being a real problem with a project. Once in a while, but pretty rare.
Yeah, the substantial improvement requirement is so iffy, I guess. There's so much confusion on that. I find it very confusing too, because what really is considered a quote substantial improvement? So this kind of clarifies it a little bit, I would imagine.
Right, and it's that part. The substantial improvement again is doubling the basis in the building. So if you bought a piece of land and with a building on it for $2 million, and the building was worth $1.2 million, you have to double the basis within 30 months on that 1.2 million. You don't have to double the basis in the land. Also, if you just bought raw land, there's no specific dollar amount that you have to improve that property. But there's also, they make reference to, it has to be more than an insubstantial improvement. So you couldn't just throw blacktop on there and say, I'm going to just make a parking lot and just hold this piece of land for 10 years. That's called land banking, and that's not allowed.
Right. And then there's one other thing, a major change that this document addresses, and I guess that's the 12-month reinvestment period for these funds. Can you talk about that a little bit?
Right. And to tell you the truth, that we haven't encountered too much of that, because what that applies to is, let's say I set up an opportunity zone fund, I buy a piece of property, and maybe even before I make substantial improvements, I sell that because I found a better piece of property, and I have a gain on there. Now the gain, that 12-month reinvestment, doesn't change the fact that you've triggered a gain, and that's going to flow out in most cases to the partners in that partnership. But let's say they sold that for $1 million and had a $200,000 gain. As long as they reinvest that $1 million into other qualified property within 12 months, then now that extends it for 24 months under the 2021 notice. Then they don't count the fact that it's sitting in cash as a negative to the fund. It won't harm the testing requirements. One final thing to add to that, because there's a lot of confusion on that, the $200,000 that I illustrated as a gain on that, you can't roll that gain back into your existing opportunity fund that it came from. But the investors could set up a secondary qualified opportunity fund and put that $200,000 in there as long as it was before December 31st, 2026, and have that gain eligible for reinvestment in the 10-year hold. So
it's like a really commingling of funds that you can't do, but just keep creating more funds.
Right. But there's definitely ways you can, defer the tax on that. But a lot of people get confused and think, as long as I reinvest those within 12 months, I don't have to report any gain. That's not the case.
No. Blake, can you? This is just like a kind of off-the-wall question. Can you use the funds that you have in an established opportunity zone fund? Can you use that as collateral to get traditional financing as long as you stack it and don't commingle it?
Yeah, that was specifically addressed in the regulations, and unlike an IRA or something like that where you can't use that as collateral, it's not only not prohibited, it's explicitly stated that it's fine to use your opportunity zone fund as collateral for loans. So absolutely, you can. Bank could make a loan.
Against that's an interesting fact that you can. Your project can be more successful or bigger or more strategic if that's available. Yeah, that's great. Let me ask you this. Of all the potential investment vehicles that are available to people, how would you rate opportunity zones and the funds that you would use in an opportunity zone?
Well, yeah. I mean, I consistently say that this is hands down the most, impactful from an economic development standpoint, community development, and it's just tremendously flexible because you can, what it was meant for is for people that had high, built-in gains in concentrated positions, whether it be real estate, stocks, whatever it might be, and this allows diversification. So if I had all of my eggs in a family-owned business, and then I sell it for $50 million, and I say, geez, I don't want to pay all the tax right now, and I'm still young enough. I want to do another venture. I can diversify it into some real estate. I can go do another startup business. I could do an incubator and help other people start businesses. It's pretty unlimited. And again, with the timelines that you have to make these decisions on what to invest in, it's, there's nothing else out there that gives you all that time. The closest thing in real estate is a 1031 transaction. You have 180 days to do everything. You can't build a project. You have to trade it for something else. So, hands down, this is just, just a brilliantly designed program, and, investors and taxpayers are getting it, and, a lot of public-private partnerships. There's just a lot of great things that are happening with this, and it'll just get better.
Yeah. The COVID situation, like we said earlier, has given people more time to investigate more things, and I guess maybe that's a positive for the pandemic, was more people found out about opportunity zones and more people are investing, and the distressed areas are in better shape, which, may not have ever happened otherwise. Nobody would have taken the time to investigate and learn about it.
Yeah, absolutely. And we're seeing it over and over where, people are calling us and going, geez, this wouldn't have been a neighborhood that we looked at, but when we looked at it, it's got pretty good bones, and we can we can definitely get behind a project there.
Yeah, and plus, Blake, you made podcasting history before earlier in the podcast when you said IRS and taxpayer friendly in the same sentence. How about that?
Yeah, it's rare, but you do some things right.
But, above and beyond what Vicki just mentioned, though, you wouldn't believe, Blake, how many people contact us off QOZmarketplace.com and ask questions such as, I need information about opportunity zones, my accountant can't help me, or my financial advisor has no idea what they are, or my tax professional says they're not qualified to give information, or something like that, So why is that? This is a program that's been around for almost 3 years, and a lot of accountants and, quote, tax professionals kind of like, they don't even know what it is really at this point. They should, don't you think?
Well, yeah, but it is fairly specialized, and it's good that people know their limitations and don't take on work that they're not qualified for. But we actually partner with a lot of other CPAs to kind of be their back office support on this. So, I would encourage CPAs, tax preparers, investment advisors that don't know to just partner with somebody that can assist them, and we'll just come in, help on the consulting and the structuring of the program, and leave the CPA in place, or the current tax preparer. They can do the tax returns and stuff. We just ask that we be allowed to look at the returns before they're filed to make sure that they they're in compliance with all the rules.
Yeah. And how do people get a hold of you, Blake? What's the best way to contact you if they want more information or need help in this industry?
Yeah, so our website is HCVT.com, and you can always just Google Blake Christian CPA, and my articles will come up and things. And then my phone number, I'm going to give you my cell number because that's the easiest way to get a hold of me during COVID. And so that's 562-305-8050.
And you'll answer that phone even if you're on the ski slopes, right? In beautiful Vermont, beautiful Utah.
I do. There's some long lifts, so I get a lot of business covered on the lift.
Isn't that great? That's really funny. But, one takeaway from this entire podcast, Blake, is all the things that we've mentioned, all the timing issues, and all the things you have to understand and be weary of, and all these different extensions and little issues here and there, devils in the details. How does an individual do this themselves? I mean, they have to align with people who are professional in this, because you don't want this thing to become a disaster for you, right? Doesn't that just strike you like this is so clear?
That's a great point, and we do have some do-it-yourselfers out there, and every one of them that we look at is wrong, and
isn't that always the way?
We can fix it, but I always tell people, sometimes it costs more to fix it than doing it right the first time. And
absolutely.
Again, we don't have to do every little part of it. If a client wants to do it, frugally and just have us have a more limited role, we could still do that. But they need to get some help. You got to get legal. We always have an attorney on the team, us as the CPAs, and then the client's input is critically important. And we welcome their current tax advisors to be at the table with us, and we'll educate them, get them up to speed, and they can run with with parts of it, and we'll step out once we have it set up for them.
Yeah, and Vicki, it's nice to have a Opportunity Zone authority figure on the podcast, don't you think? You got any last questions for for Blake?
Absolutely, Ron. Blake is so right. You have to, if you're going to do something that's complicated like an Opportunity Zone fund, it's to your best advantage to go to somebody who's an expert, a CPA expert in opportunity zones, an attorney who's an expert in opportunity zones. It's like you don't want to hire an estate planning attorney to do your personal injury because it doesn't work. They don't know what they're doing. And Blake is one of the premier CPA professionals in opportunity zones across the country, and it's to everybody who is listening, it's to your advantage to talk to someone like Blake because he is the best.
Oh, Vicki, you're too
kind. And
kind.
that's a true fact, Blake.
Well, I appreciate
that's a great way to close out the podcast, Vicki. And again, Blake, thanks so much for being on the show today. Really appreciate your input and your comments and getting the word out to our audience. Vicki, thanks for co-hosting today's episode. And folks, you're listening to the Mappable USA podcast on MappableUSA.com. If you go to that website, you scroll down the homepage, you'll see all our syndication sources. Pick the one you like best, subscribe, and you'll never miss another episode. If you want to be a guest on the show like Blake was today, there's a guest tab there. Fill that out. We'll see what we can do about getting you on the show. And if you like what you heard today, send us an email at info@MappableUSA.com. or just leave a comment on whatever page you're listening to this on right now. So thanks for listening, everyone. Thanks for your support, and we'll see you next time with another Mappable USA podcast. Have a great week, everyone.